Hey everybody, Tim Ulbrich here, and welcome to this week's episode of the RX Money Roundup segment of the YFP podcast, where we give you our take on relevant financial news and updates, answer your questions, and break down examples of financial planning in action. Today, Tim and I discuss strategies for investors to handle market volatility, which we have had plenty of over the last year. Things like how can we keep the long-term view in mind while experiencing the very real feelings of fear and anxiety that can come with some of the market bumps along the way. Before we get into that discussion, let me give a shout out to our financial planning and tax professionals at YFP that make this segment possible. At YFP, we support pharmacists at every stage of their careers to take control of their finances, reach their financial goals, and build wealth through comprehensive fee-only financial planning and tax planning. You can learn more and book a free discovery call by visiting yourfinancialpharmacist.com. All right, Tim, before I pick your brain on this question and thoughts that you have around market volatility, let me paint a picture of one example of what we've seen in terms of volatility over a recent 1 month period. So this spans end of July through end of August. So on July 22nd, 2024, the S&P 500, which is an equity index made up of the 500 of the largest companies, was at 5,564 points. 1 month later, the S&P 500 was at 5,620. So 5,564, 1 month later, 5,620. It's a pretty boring 1% increase over a 30-day period. But in the midst of that 30-day period, there were a lot of ups and downs for a variety of reasons. The low point came on August 5th. S&P 500 was down almost 7% from that initial point of 5186. And then we saw that come back up and get to the end point, which wasn't much different than where we started. Besides the stress of seeing that 7% decrease followed by the relief when it rebounded, I think there can be a temptation here in the market among investors when we see these swings, the highs and lows, to be tempted to have a shorter term view instead of that longer term view that we often talk about on the show when it comes to investing. So if we zoom out, Tim, from that one example, thoughts that you have in a time period where we're seeing a lot of volatility in the market, we're coming up on a presidential election, and there might be some uneasiness that people are feeling as it relates to their own investments.
Yeah, you kind of nerd out a little bit more. Like when I think of volatility, and I'm looking for like kind of like quantitative measurement of volatility, I think of the VIX or the volatility index, which is a commonly used measure to quantify market volatility. It basically reflects the market's expectation of volatility over the next 30 days based on what you brought up, which is the S&P 500. So when VIX is elevated, it indicates that investors are a bit nervous. They're expecting larger price swings. We talk about the mountains and valleys related to investing. And when I checked it this morning, it was at 20. And they say basically, in recent weeks, it's between 15 to 22. So 20 basically signifies a higher than average volatility. And I think it's because of the reasons that you laid out, Tim. We have an election year coming up. We have geopolitical tensions with what's happening in Ukraine and the Middle East.
Mm-hmm.
We have economic pushes and pulls, high inflation or, which is kind of cooled, but also managing interest rate change that the Fed is, trying to, figure that out. We've had shifts in like technology stocks, which can really, kind of overweight what's going on in the S&P. So, the technology sector really overperformed early in the year, and now it's kind of underperforming because things are they're missing investors' expectations. And then we mentioned the election, which always creates uncertainty and turmoil. So
Mm-hmm.
I think the so what of this is and how we do it. I think part of this is kind of understanding what's going on.
Mm-hmm.
I think part of this is kind of taking, we're looking at, the VIX is looking at 30 days. I think a good exercise is to look at the long term, the long approach, right? So one of the things that I think it happens a lot with regard to the market and invest in it is loss aversion. So we feel our losses so much more than we feel our wins.
Mm-hmm.
When the market is doing its thing, we're like, yes, kind of not business as usual, but this is great. Nothing to see here. When the market dips 20, 30%, we're like, house is on fire. The sky is falling. This
Right.
this sucks. I want to take my investment ball and go home. There's a graph that I'll talk about here that I think like really kind of illustrates this is, we look at basically the history of a bear and bull markets since essentially World War II. And it shows a graph of what the market does. And for most of the time, Tim, the market is going up. And then we have blips where it goes down. So the market
Mhm.
going up is a bull market. And then we have a blip of a bear market, and the market kind of goes down and correct. It's cyclical. We know it's cyclical. So since World War II, the average bull market has lasted 4.4 years with a cumulative total return of 155%. Now,
Mhm.
those blips or market corrections are in fact blips, compared to. So, like the average bear market, when the market goes down, lasts less than a year, 11.3 months, and the cumulative loss is 32%. But we feel that so much more
Yeah.
than the bear. So I think it's really important to say like, hey, we know this is cyclical. We know the market's gonna, crash and then recover, and then it's gonna recover, and really do well, and then it's gonna crash again. But I think people lose sight of that. So I think the question is like, what do we do? I think a big thing is we have like we have to have a plan and stick to the plan. You
Mhm.
know, a lot of what Mike Tyson said. Hey, you have a plan until you get punched in the face, and that goes out the window. But I really think that planning is our financial planning is there. If it's built correctly and your investment plan, it's built to withstand different market conditions.
Mhm.
So I think it's trusting in the process and really thinking about the long term strategy. So it's having a plan and sticking to the plan. I think it is staying focused on long-term goals. So, like I said, market fluctuations are normal. Um, Saving for retirement is going to be something that's evergreen in your financial plan until you go to retire. We know that we're going to have these dips. So I think thinking about, hey, like I don't need this money in the next 30 days. Most people listen to this don't. If we did, we would be in a much different, market exposure. So I think it's really focusing on the long term and ensuring your portfolio is aligned with your goals and risk tolerance. So it could be that oftentimes here it's like if you take a pretty big hit, it's because and you don't like it. It could be because your risk tolerance
Yeah.
or is out of whack, your asset allocation is out of whack, or sometimes we're overexposed to one security, i.e., like a stock of the company that you work for. I think the big thing here, Tim, is to avoid emotional reactions. So this is, I often say, like, we want to do the exact opposite of how we feel when it comes to investing. So
Mhm.
when the market crashes, you want to take your investment ball and go home. You want to get your money out, go to cash. And then what happens is that you are selling low and then you're buying high
Yeah.
when you feel a little bit better and the market's already covered.
Mhm.
So it's staying disciplined. Sometimes having a financial planner that kind of keeps you arm's length from pushing that button, I think is important. Um, and I think it's also looking for opportunity. So in a down market, those dollars that you're putting into for a 401k, dollar cost average, those dollars go a lot further. So it's kind of the mental gymnastics of like, all right, my portfolio is down, but the money that I'm putting in is going to go a lot further, and it's going to really supercharge the recovery when the market does recover. But it could be looking at things like tax loss harvesting. It could be looking at things of like,
Mhm.
rebalancing your portfolio or even converting some of your pre-tax account over to a Roth, because you're paying taxes on a lowered amount that you're
Yep.
covering. If you have extra cash, it might be a good time to put money into the market, which again sounds counterintuitive. Um, so I think that those are really important. And I would, part of the emotional stuff too, Tim, is like I would avoid checking your portfolio too much because it leads to emotion, and then
Mhm.
emotions can lead to irrational thoughts and irrational behavior, which can kind of come in the form of like tinkering, right? We're,
Yep.
we're tinkering, we're trying to outsmart spot the market. So I think having a little bit of an arm's length and I wouldn't say apathetic, but if you can be apathetic to say, hey, this is just part of what the market does, I think you'll be better off for it.
Yeah, this is where we've talked about on the show before, but this is where I think something like automation is so important that
Yeah.
you started with a plan, right? We have a plan. Now let's execute the plan. Doesn't mean we're not going to change the plan over time. Of course, things happen, goals happen, market doesn't behave always how we think it's going to behave. So there are adjustments to that plan, but we have a plan, we automate the plan, and we get ourselves the heck out of the way. And that can often mean in the form of, obviously we're biased, but having a financial planner, having someone in your corner that can help you, they have the hand on the wheel.
Yep.
making sure that you're informed along the way as well. But, as you mentioned, having some space between you and that decision. I also think it's worth reiterating that, I mean, there are so many complexities here based on an individual basis. Of course, this is not meant to be advice in any way, shape or form. And we never know what the market's going to do, despite people liking to think that they do. I mean, the best that we have, as you're talking about some of the history of the bear and bull markets, is what has happened historically. That's not predictive of what's going to happen in the future, but that's the best information we have.
Yep.
How do we take that data, combine it with our goals, combine it with our individual factors in our plan, layer onto that our risk tolerance or risk capacity? Then from there, we really start to begin to put a plan together. And I think all of those are incredibly important.
Yeah, and I think if you look at an investment as like one method, and it's a or one part of the overall financial plan and not the financial plan, like I think that's important, right? Because the markets are going to do what the market does, but I think it's still important to remember that things like debt payoff, or protecting your assets and your wealth via proper insurance planning and estate planning and things like that, those don't go away just because the sky
Yeah.
is proverbially fallen. So I think, like, again, it's taking a step back. It's really, really important. Again, like, for a lot of our clients, like, the tail that wags the dog with their financial plan early on is the student loans. But then after a while, that script is flipped,
Hmm.
so to speak. And then really what does wag the tail is the investments and the things around that. But that doesn't necessarily mean that all these other things aren't important. And I think it's looking at that bigger picture and understanding, where you're at. And again, I think, like, some people are like, oh my goodness, like my portfolio went down 20 or 30%. And we really haven't seen that since, like, I mean, we had a little bit of a blip in for COVID,
Pandemic.
which
Yeah.
recovered really, really quickly, but we really haven't
Hmm.
seen that since 08, 09, right? So a lot of this is, it's forgotten, or people haven't experienced it. So when it does happen, and it will, we just have to be prepared for it. And I think, like, kind of rehearsing this in your mind, and planning for it is important. And I think, yeah, that's just part of the plan.
I think something you said too, which is worth reiterating, is we're not suggesting in any way someone is uninformed, of what's going on in the markets and the economy. But I do think there is a cost of being overinformed from a tinkering standpoint. I was even thinking about that today. So today, at the time of recording, Friday, October 4th, jobs report came out. Right. So markets reacting to what happened in the jobs report. Well, three days ago, it might have been that Jerome Powell, looked a certain way while he was giving a press conference, and people are conjecturing of what's going to happen in the future with interest rate cuts. So, I
Yep.
mean, this is day to day, sometimes hour to hour. And if you're in it, especially Tim, I'm thinking of our listeners that maybe have amassed million, $2 million, $3 million, you might see 30, 40, $50,000 swings on the ready. Like, you got to really have, I think we're going back to, like, what are the goals? What are the plan? What's the risk tolerance? And are we keeping that long-term view in mind? So,
Yeah, yeah, and I think, it's kind of, going through, like, swings in the market. I almost kind of equate it to, like, the political season, where I'm like, all right, I'm ready for the election to be over. It's kind of in your face, and it's like,
hmm
it's not necessarily the most positive news, and I think that can wear on you over time. So,
hmm
I think it's have a plan, understand where investing fits in the context of your plan. And I mean, again, like, if you're going to retire next year and the market goes down 30% and you're mainly in equities, like, that's the problem, right? Like, we shouldn't be there. So it's looking at the plan and working with an advisor, in my opinion, to say, okay, how do we combat sequence of return risk with what we can do
hmm
with the, inside of the portfolio. And some of these are, even, even if you have a very conservative portfolio, you're still at the whims of interest rates, bond
Yeah.
prices, and the market, because you're still going to be, invested in equities in some form or fashion. So, a lot of this market risk, there's no way to diversify out of it. And unfortunately, we can't take all of our money out and stuff it under the mattress, because we know that the inflation, bed bugs are going to come and eat away at your
hmm
purchasing power year over year. So it's something that we have to be comfortable, taking intelligent risk in the market. And I think, understanding where it fits in the greater, of your financial plan is super important.
Great stuff, Tim. Appreciate everyone listening. If you have a topic you'd like us to cover or a question you'd like for us to answer on an upcoming episode, send us an email, info@yourfinancialpharmacist.com, or you can send us a voice memo by visiting yourfinancialpharmacist.com/ask. And as we wrap up the episode, an important reminder that the content in this podcast is provided for informational purposes only, is not intended to provide, should not be relied on for investment or any other advice. Information on the show and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial products. And for more information on that, you can visit yourfinancialpharmacist.com/disclaimer. Thanks so much, everyone, for listening. Have a great rest of your week.